All right, everyone, it's that time of the year. It's tax time, and there's things we need to know. There's things we need to be prepared for. And so what better time than to have a conversation about your taxes than right now? And our guest today is going to share some information to help us all be prepared. Stay tuned. Good morning, everyone, and welcome to Scan FYI. So yeah, it's tax season. There's lots of things we want to talk about. We want to be prepared because I don't even remember what the deadline is, but that's okay. My guest will tell us. So today our guest is Adam Rubin. And actually, this is part 3 of a 3-part series. So good morning, Adam. Thanks for joining us.
Andrea, as always, it's an absolute pleasure. Love anything I could do with Scan, and
Thank
love
you.
anything I could do with you, Andrea. Wonderful.
Thank you so much. Well, for those out there who might not have tuned into the previous part 1 and part 2, and I will link them below so you can catch up. Adam, why don't you just share with our viewers exactly who are you and what do you do?
Okay, my name is Adam Rubin. I'm a Jersey Shore guy through and through. A little personal first, right? I live down the shore with my wife and 2 little daughters. I think one of them you can see behind me. I texted my wife before and said I need pictures of the baby because you can't see her here. That's personally. Professionally, I am an estate planning and tax attorney with the law firm Levine Furman Rubin. Very proud to work here. The firm's been around 41 years, offices in Jackson, East Brunswick, and this is a real focus. You know, if you need to sell a house, I can't help you. I can get you the names of great people. If you need to sue someone, also not my cup of tea. But in terms of planning and protecting your assets and your loved ones, that's in my wheelhouse, as they say.
All right. And, as we learned in part 1 and part 2, preparation is everything. And for those out there who are thinking, why does it really affect me? Why do I need to do this? I feel like for me personally, even one of the things that we learn is when you prepare yourself and your family and have all your ducks in a row, you're reclaiming your power. And you get to say what happens. You don't worry about what anyone else has to say, what the state has to say, what the government has to say. It's really all about reclaiming your own power. So today we're talking about federal taxes, which, we all got to pay them, I think. So what do we need to know? What's the story on taxes?
So I wanted to focus really and more, yes, as you mentioned, Andrea, taxes are due April 15th.
All right, April 15th. I blocked it out. Yes.
It's all right. I think 99% of us wish we could block it out. So, it's not a day that someone's looking forward to. And I wish I could tell someone, I wish, Andrea, we'd be the most watched podcast in history if I said, here's over the next 20 minutes how I'm going to tell you never have to pay $1 of tax. But fortunately,
I'm not going to do that.
Not that powerful. So I just wanted to talk about some of what's happening with some of the tax changes, particularly we will touch on income tax, but I want to talk about some of the gifting rules that could really impact seniors. Some of what's happening with the retirement accounts, which I know everyone's always buzzing about. And then we'll talk about estates a little bit. So if it's okay, I just want to touch on the gifting rules because this is something, I think this is the most common misconception I hear amongst seniors tax-wise. It is the most common one. So I just want to, for 2 minutes, explain it to everyone. Hopefully, if they want to rewatch it, great. But I have a funny feeling this is going to be a phenomenal resource for a lot of people. Okay, so everyone always asks, how much could I gift to a family member? Okay, the rule is they increased it in 2023, so you can gift anyone. You can gift a family member. You can gift Andrea. You can gift Adam Rubin. Anyone you want, you can gift $17,000 to. Okay, if you're married, you can give $34,000 to this individual. All right. So if Andrea, I'm married, I can give you $34,000. The government doesn't even care. 17 per. If you go over that, everyone always thinks, oh, if you go over it, you have to pay tax. That's just not true. If you go over the annual exclusion, which this year again is 17,000, you do not necessarily have to pay tax, because we all have a lifetime gifting amount, a lifetime exemption amount that you're allowed to gift.
Okay.
Right now, that exemption amount is 12.8 million per person.
Oh, most of us don't have to worry.
So if I wanted to give Andrea 17,000, the government doesn't even care. If I wanted to give her 2,017,000, the first 17,000, the government says, we don't care about that, Adam. You can give it to anyone. That next 2 million, I still don't have to pay tax on. It just reduces some of my 12.8 million. So if you're going to give over 17,000, I don't want people to think there's tax. You just have to notify the IRS about it, but you don't necessarily have to pay tax. And the place we notify the IRS is we file something called a Form 709.
Who's filing that form? The person who got the money or the person who gifted?
The person who's making the gift, the gifter.
Okay.
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 So that, I wanted to touch on that because that, so many times people come in and they say, hey, I want to make a gift, but they ask the questions you're asking. So always want to, and that is very important. I don't want to go sideways because Andrea told me tax today, but that is just an IRS rule. So please, if you're talking about transferring assets to protect them from an assisted living or nursing home, please don't think that if you give 17,000, that Medicaid's not going to bother you. That's a different talk for a different day, but I just want to clarify that this is just an IRS rule.
Well, I mean, that is good to know because obviously lots of seniors, lots of families in general want to make a gift. But just to clarify now, so I can give a gift to my child, to my nephew, to my best friend, to my boyfriend, my girlfriend, and 17,000 and nobody cares.
Correct. Well,
okay.
I mean, if you give 17,000 to your girlfriend, your boyfriend might care, but no.
Well, that's a good point.
Bad job.
But okay, all right. Well, that's good to know because it used to be 10,000.
Yes.
Okay.
And the reason when I knew we were having this talk about tax, I told our marketing director, I said, I need to talk about this because this is something I probably 4 times a week as an estate planning and elder law attorney get this question and no one seems to understand it. And I think it's something in 5-10 minutes we could clear up for people and put them in a better place.
Thank you for that because, well, that is important. Holidays, people want to give presents, birthdays, people want to give presents. So, okay, very good. Excellent.
And everyone's always worried, I give it, but what is there going to be tax? And so people need to understand that.
All right. So the magic number is 17,000.
Yes, for the next 340 days. And then it goes up.
Right.
It's adjusted every year for inflation. So
okay. So all right, got it. Okay, yeah. That's interesting, actually. Good to know. Next topic.
Okay, so next I just want to talk about
taxes.
Of course, it's all about taxes. Next, we have to talk, and this is something very important because it's constantly changing, is the Secure Act and the Secure Act 2.0. Okay, for the longest time, the minimum age, when people got to 70 and a half, they had to start taking out of their retirement account. Okay, so just to take a step back, we'll take an IRA, a 401k, a 403b, all these accounts where for years we could put money in so we didn't have to pay tax.
Right.
Right?
Right, exactly.
And they're great. Well, the IRS eventually says, okay, that's cute, but eventually we want our money. So for the longest time, for as long as I can remember, you had to take distributions out starting when you were 70 and a half that year. Okay. And the way you take it out, just so people know, is you take the total amount in your retirement account. So let's say Andrea has 26 million in her retirement account. Yes. And you divide it by your life expectancy. So when Andrea was 70 and a half, her life expectancy was 26 years, hypothetically. So you take the total amount and you're going to divide it by life expectancy. So 26 million divided by 26, Andrea is required to take $1 million out
Per year, per year.
that year.
That
Every
year.
year it's
Oh,
recalculated. Every
okay.
year your life expectancy is adjusted, and
Oh,
the amount in the retirement account on December 31st moves. But you're required to take that amount out and pay tax on it. Okay, so I want everyone to understand, because everyone, these are, Andrea, the itinerary today was just misconceptions and the most common questions I deal with, so we can get the SCAN community in a better place. That's kind of my priority.
when you take that money out, that's like you're paying your salary for that year from that money that you've been squirreling away for all those years. So now there's a tax consequence, correct?
Correct. Exactly. They want their money. They want to pay tax. They want
Okay.
it back in the system.
Okay. That makes sense. Okay. And if for some reason you don't take out enough or you don't take out any,
If 50% penalty.
all right. See, now that's important to know. Okay.
Yes. Now,
They're gonna get you.
oh, yeah, that's what they do.
All right.
Um, so that's how it works with distributions. Now, the second part of distributions, and then we'll talk about how they've changed it the last 3 years. Second part is everyone always thinks, man, I really want to go to the Bahamas. I have lost money in my IRA, but I can't take it because I'm 70 until I get to the age of required minimum distributions. That's not true. Anytime you get over the age of 59 and a half, you can take a distribution out of your retirement account. You can do it. It's just you have to pay tax.
Okay. So at that point, it's an option for me.
Yes.
Okay.
So if someone's 65 and they want to take money out of their retirement account, they absolutely can do it.
Okay. I'm equating it to Social Security, where if you want to take it before you're 70, you can, but when you get to 70, you must.
Yes, essentially.
Not exactly the same, but
yeah.
okay.
And
All
that's
right.
and the age where you must take it is called your RMD. Some people call it your MRD. It's just your minimum required distribution, your required minimum distribution.
Okay.
You know, I know in Jersey, what do they always say? Tailored ham versus pork roll. Well, it's like in the tax world, they say RMD versus MRD. That's who we are. So now they recently, in a couple of years ago, when they passed something called the Secure Act, everyone knows about it. It was, I believe it was part of the act where they capped how much we could take as a property tax deduction and all those great things. They increased the age at that time to 72. So you don't have to take distributions to 72. Now, recently, Congress is in the process of passing the Secure Act 2.0, which actually is going to increase the age to 73. So you don't have to take distributions till 73 now.
Is that going to be for 2023?
Yes.
Okay.
So this is very important. Now, if you're not in the pay period. Okay. So once you're in the pay period, you're taking it. Now, also what they changed is if you're married and you pass away, your spouse can do what's called a spousal rollover and take the distribution over his or her life expectancy. Okay. So that has always been the way it has been. But with another change, and this is a big one, is your children, your loved ones, when you pass away, they have to take the retirement account out at over 10 years. So let's say, I will pick on Adam, right? Adam wanted to leave his daughters his big IRA. It used to be that the daughters could use their life expectancy, Andrea, and it would be taken out over 70 years. It was amazing.
Okay.
Now, the moment my daughters, because my daughters are minors, the moment my daughters get to 18, they have to take out the IRA over the next 10 years and pay all that tax over 10 years. So people need to know this. You really have to rethink about how you did some planning, you know?
I gotta say, Adam, one really important thing to say here for someone like me who's just a regular person, and I'm guessing most people are going to be like me, a regular person. How would I know this in a million years?
Well,
I wouldn't.
That's
I
that's one
wouldn't.
of the reasons I wanted to talk about it today. Because
Right.
it's right.
But I think it also kind of underscores the importance of speaking to a professional at some point, because I know lots of people do their own taxes and figure this all out themselves. But my feeling is you might be missing out on some important opportunities, or you might be doing something completely wrong and not even know it. And then you're going to get a penalty down the road, just out of your own ignorance. So that's what I'm really getting that from this conversation. It's good to know, but I couldn't do it myself. All right. I
No,
wanted
thank
to
you.
say that.
And not to give Scan more credit, but that's one of the reasons I'm so drawn to Scan, because to me, a large part of Scan is about personal growth, education at any age.
Yes.
Because education's king, because we only know what we know. And you always see those pictures where we know like 1% of everything the road has to give us, right? So this is what I do, but believe me, my wife can tell you there's a long list of things I don't know.
That's
So
another show.
right. So we have to focus on what we know. So
Yes.
I agree.
Okay.
And that's why
Right.
that's why these were the topics, because it's just Andrew, day in and day out, I see it where people don't have questions about this. So I was like, you know what? If I can get this out there and help some folks along the way, it'd be
We're
amazing.
learning a lot today. We really are. Okay.
Mhm. Okay. Um, now I have some good tax news, right? I know we touched on this in a prior session, but I just want to revisit the estate tax. So right now in New Jersey, we do not have an estate tax. So if Warren Buffett lived in Jersey and he passed away and left, and he wanted to leave $40 billion to his children, New Jersey would not assess an estate tax.
Wow.
Right. Now, New Jersey does have, of course, it's New Jersey, so they have to slide in something fun for us. They do have an inheritance tax. And the inheritance tax doesn't look at how much you own, it looks at who's getting assets. So if Warren Buffett wanted to leave something to a niece, a nephew, or maybe a cousin, all those people are subject to New Jersey inheritance tax. Okay, it's not children, not spouse, not parents, not grandparents. But if you're considering leaving something to a more distant relative, a friend, New Jersey's going to get you with an inheritance tax.
They're going to get the friend, the
No,
person.
it depends. When you die, there's going to be a tax. Who's going to have to pay it depends on what your documents say.
Okay.
Sometimes you say, let's say I want to leave Andrea $20,000, right? We're being very generous on this phone call, right? It's I want to leave Andrea 20,000, and there's going to be a tax on that because we're not. But our relationship is called Class D of about 15%, so it's going to be 3,000. Now I want Andrea to see her name in my will and say, "Wow, that's so nice. Adam gave me 20,000 and get the 20,000." So in my documents, I can write, I want Andrea to get it tax-free. Or I can say Andrea gets 20, but she has to pay her own tax. Either one is fine, but that's what controls.
Again, the importance of speaking to someone about your will and getting it organized in the right way so that you don't have a surprise and the recipient of your money isn't going to have a surprise either.
Mm-hmm. And
All right,
there's
interesting.
a client taught me this phrase and I love it. And it's semi-related to what you're talking about. Hope is not a strategy, right? Hope is not a plan. So
Yeah, very true.
So, we hope we get it right. We hope no one fights. We hope there's no tax, but these things have answers, so we find them out.
And the rules are changing year by year?
Year by year, every couple years, we'll say. I mean, there's minor modifications. It's been a very active period. the big change that everyone's talking about is coming at the end of 2025. So what's happening is on the federal level, right now, Andrea can leave, I can leave, anyone can leave $12.8 million to their family tax-free on the federal level.
Okay.
But if you have over that, are you sitting down, Andrea?
Oh, yeah.
The tax rate is 40%. So it gets high real fast.
Yeah.
You know, in 2025, they're going to lower that. The current tax law is expiring, and it's supposed to go down to 5 million adjusted for inflation. So it's probably going to end up around 6 million.
Okay, well, let me just say, if any of my relatives are listening, you don't have to be concerned.
Right. Like I hope everyone listening to this call has to pay a major estate tax, because that means
I know that should be your biggest problem.
right.
But Adam, if you do your will in let's say you did whatever you did in, I'm just going to random 2020, you did your will, you got all your tax things in order, etc., and you pass away in 2023, this year. Does whatever you had in your will stand, or does it change based on what the new laws might be in 2023, the year that you pass away?
So unfortunately, in terms of death taxes, there's no grandfathered in.
Okay.
It's the laws when you pass.
All right. So that's good to know too. Okay.
Yeah. It's not, there's certain gifting, certain strategies we do where you are grandfathered in, but not for death taxes.
Okay. All right. Okay. Yikes. Lots to think about, everybody. Again, the importance of speaking to a professional at some point so that you don't make any mistakes.
And these are good things, it's good. Like,
yes. Well, I keep saying it, I think of it as reclaiming your power so that you can make the choice, and the choice is not made by a relative you didn't want to make the choice, or the absolute worst is when the state intervenes, right? And they make choices about your estate.
I don't know if that's worse than family, but either way, depends on your family. But either way, it's just so important for all estate planning. Outline your wishes, absolutely, because the big thing is, in my area of the law, we very rarely can we go back to the people and say, is this what you want? Is this what you intended? Because they're not with us at the time. So yeah, it's very important, just switching lanes, getting your affairs in order. Absolutely. But number one thing's important is just the education.
Yes.
I always say that if you understand it, whether it's the tax, whether it's estate planning, if you understand your options and you decide to do nothing, that's your choice, but at least you're making an educated choice. You're not doing it out of ignorance.
All right. Any final tax info you want to share?
We can take a step back and talk more about the gifting, because that's always a hot button issue, right?
All right, let's kind of end on go back to the gifting. What's a final thought about that?
Okay. Well, first is if you give to a charitable organization, there's no limit for that. So I just say a general. So everyone for scan. No, I'm just kidding. Sorry. But if you gift, I just want to go over that. If you gift more than the annual exclusion, which this year is 17,000, you do have to file a return. The return is due in April, but you can get an extension to October. Okay. And again, there's no tax due. It's not the most complicated return, but it is important you file it. Okay. And the number one thing is, last thing I'll say is with these retirement rules, they seem to be changing more than anything. Please keep an eye on them, because that 50% penalty is very unfortunate, and it's very easy to avoid. Most of your financial advisors, your tax attorneys, your accountants will be able to help you. But the number one thing is, for yourself, please open your mouth, just ask these questions so you can be in good shape.
The expression, ignorance is no excuse. And I feel like that's very true here. And most of us don't know, because how would we know? We might read about it, or it goes in and it goes right out. But again, the importance of speaking to a professional so that everything is done correctly.
Mhm.
All right. Well, Adam, wow, this was excellent. Thank you so much. So again, this was part 3. I will leave links to part 1 and 2 if you want to go back, and I suggest you do go back and listen to parts 1 and part 2. Everything has been very informative, very important info. Thank you again.
Thank you. It's always great to see you, Andrea. I'm very proud to be part of such a terrific organization. And yeah, anything I could ever be a resource, because like we
Well,
say, education's king, personal growth, baby. That's what it's all about.
that's right. That's for sure. So remember out there, if it's important to you, it's important to us. I'm Andrea Tarr, and we'll see you next time on Scan FYI. Bye, everyone. Bye, Adam.